Hello everyone, welcome to Just Invest Today, and today we have a good video. We're talking about Charlie Munger's wisdom and what he said to a class of CalTech in his new interview. So everything he says in this video, this is what you guys need because this is what's going to get you to become a better investor. We're looking at the traits that make you a better investor, and he breaks it down really nice and really smooth, and we're going to get into it in this video. The first trait is that you have to have some kind of inclination to investing. You got to have some kind of passion towards it because think about it. Warren Buffett has been teaching investing for decades and decades, and he keeps saying the same thing over and over again. He's literally laying out the blueprint to investing. But guess what? A lot of people do not take to his strategies, to his wisdom. They just don't accept it. They don't believe it. There's been articles trying to disprove it, and there's been so much stuff trying to go against the grain of what Warren Buffett says, and they're calling him lucky, and he was just the lucky person out of a group of investors. But that is not the truth. He's laying out blueprints and telling you how to invest, and people refuse to follow it. So that brings me back to this point that you have to be kind of inclined to take advice, be a little passionate, because when you become passionate about a subject, you want to spend time on it, you want to learn about it, you want to invest so much into it. So there has to be a little passion towards it. And then when you have that passion, you're going to follow these steps and steps to take to become great investors. Second trait, you got to know a lot. And when Charlie says this, he means that you got to read a lot of information. You got to get around to a lot of knowledge and kind of build that up by reading 10Ks, reading financial news, reading books about the world, about anything that's going on, right? Because once you read a lot of books and get a lot of knowledge, that compounds over and over. And then when you see a company, you can take knowledge from this place and bring it back into this company that you're investing. Or you can take something that you learn here and it brings it back into what you learn, what you know about investing in the kind of the company that you're researching. So just getting a lot of knowledge, compounding that knowledge over time and over time is going to lead to better investments and just more knowledge on companies and just the general market in the sphere of the investing world. So you got to know a lot, so that means you got to read a lot. Third thing, you need a stable, rational temperament. And this is so key. This is 50% of the battle, guys. So when we think about investing, we make more money when we're waiting than when we're actually putting in money. Guys, the key to investing is we gotta buy at a margin of safety price, a price that makes sense. Because when we buy these high prices, we're not gonna make the returns that we want. And in order to buy these low prices, you gotta think about it. These companies that we want to invest in, they're all really good companies. They're not selling cheap on the market. So when you think about it, we have to be patiently waiting for our opportunity to strike. So we got to strike at the right time. And in order to do that, we got to be very patient. So we're waiting for some kind of macroeconomic situation, just like what happened with COVID, and it dropped so many companies down for no reason. These companies were going to survive. They had good balance sheets. They had everything perfectly working with them, and their prices dropped. So that was a perfect opportunity. I hope you guys didn't miss it, but that was a perfect opportunity to buy stocks, right? Or we look for a business situation where something happens in the business, a short-term problem, but it doesn't matter because in a year that problem is going to be fixed, and that problem is going to be able to be handled and survive. And guess what? That stock's going to shoot right back up because it lost 40%. This is how Warren Buffett makes his money, by being patient and waiting for these situations. So that's the third thing to get right, to kind of jam in your head and get that knowledge down. Fourth thing, we need to be able to defer gratification. I feel like this is a huge struggle for everyone. We all have that temptation to do something very quickly, very immediate, and we want to get that reward right away. But that's not how you invest. We got to be, again, patient and willing to wait instead of going for that immediate gratification. Two things come to mind when it comes to deferred gratification. The first thing is everyone is so quick to just want to buy and buy and buy and buy and sell and sell and sell in the market. They're so active. They just want to be active just to be active because they want to see immediate returns. They think that the more they buy, the more they sell, that's going to get them the rewards they need. And they want to see that growth in their account. They want to see that number growing and growing. So they keep buying and selling and buying and selling. They have no patience to wait. And you see this all the time, especially in Robinhood investors, people with options. Like, how many people do you think are getting rich on options instead of long-term investing, which is the holy grail of investing? So yeah, so that's not the way to invest. It's all about being patient. We're not buying and selling and we're thinking we're doing a lot. People always think they're doing so much when they're buying and selling, but they're not doing a lot. They're barely making returns. They're barely making money. It's hard to sell on an investment when you have that in your head that you want that immediate reward. And the immediate reward is seeing your money increase, and you think it's increasing, but you get that one hit of a bad sell and then boom, you lost all those returns. So that's one of the things I see in the market, that people can't defer that gratification. The second thing when it comes to deferred gratification is that people tend to not be able to actually hold on to their stocks when it keeps going up and up and up. Like they think they need to sell that stock right away just to capture those gains, try to get those capital gains. But sometimes that's not the best thing to do. Sometimes it's best just to hold on, wait 2, 3, 4 years with that stock if it's a very good company with a strong competitive advantage. People just want to see that money come into their bank. They're just so quick to just sell their stock when it even goes up, what, 10% only? Like, and if they held on to that stock, it would have went up, it just went up 40 times or 400% or like whatever percent it went up because we weren't patient, so we sold too early on that stock. So sometimes we're unable to do that. And I even struggle with this myself, selling stocks way too early. And it's a bad thing. You feel bad after too, because like you just look at the stock, it's just increasing, and you already sold off your whole position. So man, like, so deferred gratification, I feel like is very key to your investment success. The fifth and sixth thing is kind of combined together. It kind of goes together, and that's the willing to wait and being able to be very patient and very aggressive in different times. So let me explain. Think about baseball. Baseball, you're allowed to have your bat, and when you have the bat, you only get 3 strikes to hit the pitch. So, but in investing, you can wait there as long as you want. It doesn't matter. And the ball just keeps coming by, and you can wait for that right pitch. But in baseball, you have to swing eventually, or you're gonna get 3 strikes and you're out. So when we're investing and we're waiting for that right pitch to come by, that's when we see that pitch that we want is in our circle of competence, and then we swing at it with all our might. That's when we're dropping 10 to 15% of our money into that company. That's going to show us how confident we are, how knowledgeable we are in that investment, and it just shows us that you got to be that courageous, because you cannot tiptoe into these investments, especially when these events that drop the prices of these stocks. It does not happen a lot. It can be once a year. It can be once every 3 years. Can you imagine only putting 5,000 or even 5% of the money that you have, when you could have put like 15,000 or whatever, 10, 15%? These events, these situations do not come up again. Like, think about this COVID situation. You think how long is that gonna come again? Like, when is that gonna come? It probably won't never happen, maybe in your lifetime. Maybe it will happen again. But that had a huge buying opportunity. So people who tiptoed during that time didn't make a lot of money. They just put like a little bit, only 2%, 5%. People who actually knew that there's a huge opportunity and put 15% in the company, put a 20% in the company here or there, Those are the people making the big gains, especially when you have a strong conviction of a company. You know you're right. You know there's a lot of potential for growth. You know it's a strong company with a strong balance sheet. It's not going to go bankrupt. You see all those things. It's returning high on your equity, high on invested capital. And it just went down because everyone's afraid. Everyone's getting out the market. So those are those buying opportunities that you have to take advantage of. You can't tiptoe into these stocks. You got to thrust with all your might and be very aggressive in buying these companies when the time comes. The last thing, guys, the last thing is that we have to be very, very self-aware. We have to know where our circle of competence is. This basically means that we got to know where we can invest and where we can invest, what we know about the world and what we don't know, because what we don't know is actually very more important. It's very key into our investment practice because think about it. I have no idea about pharmaceuticals. So I don't invest. I don't try to learn about pharmaceuticals, or it's not my area expertise. I know about more stuff that I actually like. Like I like Nike, I like cell phones, like stuff like that, like stuff that you actually use in everyday life and you can kind of understand the business. There's not a high barrier to like learn about the company, right? So learn what you like, invest in what you know already. And if you want to learn more about a situation or about companies, you can still do that. But like when you want to put a lot of money into a company, you got to know what it's about and know everything about it. So be aware of what you know and what you don't know about the company, about an industry, because that's where you just lose out, because a lot of the times you think you know a lot about pharmaceuticals and you don't know a lot, but you still invest in it because maybe your friend told you about it, and a situation comes up in the company that you know nothing about and you have no background information about, and then you panic and then you sell. Even though that situation could have been very minor and nothing, you have no idea because you have no background in the pharmaceutical industry. So you just sell the stock in the wrong time and boom, you're in a huge loss. So be aware of those companies that you know and that you have a background in, that you can invest in. And then if you want to expand to like different industries, you can still do that. But just know that you got to like build your knowledge up, just build on that like information. We have to make investing very simple. Jump over those 1 foot bars. Why are you going over to 6 foot bars to jump over? And those 6 foot bars are companies that we don't know nothing about, like the pharmaceutical industry or maybe the oil industry, whatever it is. Stick to what you know, and that's what's gonna help us understand these businesses and make solid, sound investments. And that's it for the video. If you guys like this video, can you please like it, subscribe to my channel, and I'll get back to you in the next video. Peace.